Good afternoon. May I ask you kindly to be seated? Good afternoon, everyone, and a warm welcome to the House of the Euro. The House of the Euro, as you know, in Brussels brings together the European Central Bank and many central banks, national central banks of the Euro area. So we have a joint house to welcome you, and also a warm welcome to those following online our event. I'm pleased to welcome you to this joint IMF-ECB event on the recently published IMF Regional Economic Outlook for Europe. With me today are Alfred Kammer, Director of the European Department of the Fund, Christiane Nickel, Deputy Director General Economics of the ECB, Maria de Mertzis, Senior Fellow at Bruegel, and Maria Tadeo, the European correspondent, who will moderate this talk. So, to start off, we will have a presentation by Alfred on the Regional Economic Outlook that was just published and which discusses the agenda for the reforms the EU needs to carry out to tackle structural challenges. And this will be followed by a panel discussion with the speakers I just introduced and a touch on the key themes of the IMF's report, including, of course, the outlook, but also looking at long-term competitiveness and how to leverage the single market to unleash Europe's potential. This discussion today is really topical given the end of the current legislative term ahead of the EU election and the priority for the new commissions. And as said, our discussion will be moderated by Maria, and after the talk you will of course have a possibility to ask questions, and so we are together for a good hour. And again, thank you so much to the IMF team, in particular to James and his team for collaborating for this great event. And with this, let me give the floor to Alfred. Thank you.
So good afternoon to all of you, also to our online audience. And thank you, Mr. Kislievsky, for welcoming us to the House of Europe. Today's seminar takes place 2 years after Russia's invasion of Ukraine, a large energy crisis, and the emergence of a more divided global economy. Europe has successfully navigated through this tumultuous period, and a soft landing has now come within reach. But this, in our view, also puts the spotlight on what may be Europe's most fundamental problem: to sustain the recovery and lift its still miserable-looking medium-term growth outlook. Here, an important new debate has begun about the blueprint for Europe's future growth model. Just 2 weeks ago, 2 important reports were released: Enrico Letta's Much More Than a Market and Christian Noyer's Developing European Capital Markets to Finance the Future. They outline in a convincing fashion the case for a more integrated, green and inclusive Europe. In today's speech, I will outline what we see as Europe's main growth challenge, provide you with estimates of what reforms can potentially achieve, and outline what Europe needs to do to reap these potential gains. Let me start with some good news. Europe's recovery, fueled by domestic demand, is firmly on track. The latest GDP data for the euro area show growth slightly above expectations, with all major economies performing slightly better than anticipated in our April 2024 Regional Economic Outlook. The recovery is driven by improving consumer and business sentiment. Household incomes are supported by resilient labor markets, which have added a recovery in incomes. In many countries, disinflation has continued and is paving the way for interest rate reductions. As of April 2024, headline inflation in the euro area has remained stable at 2.4%. Core inflation has also decelerated. Despite this positive news, inflation rates remain elevated in several European countries. This necessitates a careful and measured approach to monetary policy easing. We project that the ECB will reduce its policy rate starting in June with cuts of 25 basis points each quarter until it reaches a neutral stance at 2.5% in September 2025. This seems appropriate under current circumstances. In Central and Eastern and Southeastern European countries, we also see rate cuts ahead, but disinflation has further to go. For that reason, monetary policy will need to remain tight for an extended period. Finally, a brief word about fiscal policy. The current recovery also provides the opportunity for more ambitious fiscal consolidation. Labor markets are tight, public debt ratios have risen, and output gaps are near zero in many countries. For these reasons, we recommend a less backloaded deficit reduction than currently envisaged for 24-25. While Europe is doing better now, deep structural challenges, aging, climate change, and global fragmentation await. Unfortunately, Europe does not enter this period from a position of economic strength. Europe's income levels are below the global frontier. Compared to the United States, the average EU per capita income is around 1/3 lower than in the United States. This gap is large and has widened over the last 2 decades, even for many of the wealthier economies. Under current policies, this gap is unlikely to narrow for decades to come. The primary factor behind the income disparity with the United States is Europe's lower productivity. A smaller EU capital stock and labor input explain about 1/3 of the difference. However, the bulk of the gap, nearly 70%, can be attributed to lower productivity. The comparison holds true if more granular data such as aggregate hours worked are being used. This pattern is also reflected in data at the firm level. Since 2005, US businesses have consistently outperformed European firms, with the productivity gap widening even further after 2014. So what can Europe do? The way to higher growth may lead through the single market. A recent IMF study finds that reducing remaining barriers in the single market for goods and services by 10% could raise European output by as much as 7 percentage points over the long term. That's a large number. Trade integration in the EU is still only a fraction of the level observed among US states. Services trade, in particular in transportation, distribution, and logistics, remains constrained. These markets need to be opened up to raise incentives for productivity improvements. Where markets are open, harmonized regulations, lower administrative and legal barriers, and streamlined trade procedures would also lower business costs. Better border infrastructure, such as transportation, ICT, energy, and financial payments within Europe alone, could lift Europe's trade and incomes by about 1.6% over the long term. Strengthening the single market along these lines will not only help growth, it is also the right answer to geoeconomic fragmentation as it strengthens resilience. When Europe's trading partners increasingly use inward-looking and protectionist policies, the best response for Europe is to lower its internal barriers and realize the potential of its large market. Indeed, Europe is in a unique position among the main global blocs. While the US is specialized in innovation and China in manufacturing, Europe has capabilities in both areas. It innovates and has affordable manufacturing locations. This middle place offers Europe an advantage that allows it to grow in the face of rising fragmentation pressures. Another benefit of a more deeply integrated single market is energy security. Since Russia's invasion of Ukraine, European energy security needs have risen. In a forthcoming study, we find that integration would improve energy security along 2 dimensions: security of supply and economic resilience. The example of the electricity markets is instructive. Deeper integration would increase electricity trade between European countries. Even though more electricity trade would increase import dependence, it would reduce the geographic concentration of energy imports among non-European suppliers. Countries also become less sensitive to energy supply disruptions because energy prices and hence energy expenditures fall. In addition to free trade, the single market has 2 other key dimensions, capital and labor. They are critical for Europe's growth and its resilience. But before I turn there, let me briefly discuss how not to address fragmentation when it comes to subsidies. Engaging in a subsidy race in response to the global surge of industrial policies does more harm than good. Implementing policies that are not coordinated across the European Union could severely disrupt the integrity of the single market. It could adversely affect member states and ultimately slow productivity growth. There is, however, a concerning trend. Since the start of COVID, the number of subsidy measures imposed by EU countries that detrimentally affect other members has surged by more than 50%. In forthcoming work, we find that national state aid creates larger employment and revenue losses for competitors than the gains generated for the recipients. So overall, it's a net negative. The effects can be even more pernicious if the measures induce tit-for-tat policies between governments. This is not to say that there is no room for subsidies. In cases of well-identified externalities, subsidies can improve welfare. Europe already has the tools to address externalities while preserving the level playing field of the single market. Examples include carbon taxes or infrastructure user fee schemes for roads and network services. But countries should not go it alone. They should deploy them at the EU level to maximize gains. Finally, in situations where strategic considerations come into play, such as those related to economic or national security, subsidies need to be applied with precision. They should be narrowly targeted. This ensures they do not become too costly and do not compromise the competitive landscape. So what else can Europe do to achieve faster productivity growth? Let me step back and first recognize that Europe's productivity deficit extends across sectors and firms. The following chart is illustrative. The share of Europe's high productivity sectors in total output, 10%, is about 1/4 of the share in the United States, where it is 44%, while the share of low productivity activities in Europe is much larger than in the United States. So to enhance productivity, Europe requires either more or larger firms at the productivity frontier. It must also elevate medium productivity firms to high performers and enable low productivity businesses to either catch up or make room for high labor productivity firms offering better paying jobs. The Capital Market Union is critical to catalyze productivity growth across the entire spectrum of firms. Indeed, for Europe, creating a true capital market union is not about mobilizing more savings. With unrestricted access to global and European savings, the challenge is not a lack of funds. It is about removing barriers that prevent capital from flowing to where it can be used most productively. Currently, there are still large gaps between the United States and Europe in research and development expenditure in crucial technologies. In areas such as software and electronics, Europe has fallen behind. Similarly, the adoption of new technologies in the areas of robotics, big data, artificial intelligence, and mobile networks is not as advanced. Progress in these strategic areas requires higher private investment and public spending. But the number of market firms participate in is limited because it is too often too costly for them to operate in different jurisdictions. This in turn stymies investment in productivity improving technologies. What Europe needs are simpler regulations and tax procedures for investment income, harmonized accounting and bankruptcy frameworks, and integrated capital market supervision. A second area where a complete capital markets union can make a difference is venture capital. Compared to the US, EU countries have 1/10 of the funds over the last decade for startups or ventures who strive to become established enterprises. EU capital markets have remained segmented across national borders, with institutional investors playing significant home bias. As a result, EU equity markets are smaller and less liquid than in the US, resulting in lower valuations for listed firms. So to grow a thriving venture capital ecosystem, a larger pool of risk capital is needed. Policies can help to some extent. For instance, expanding funding from long-term investors, such as pension funds and insurance companies, could lead to a significant increase in available venture capital. This would make it easier for innovative entrepreneurs and small firms to scale up while staying in Europe. Capital market development would also facilitate a successful exit for early-stage investors, raising incentives to further investment in dynamic firms. Finally, developing EU-wide financial products tailored to households could be considered. For instance, private pension products with uniform tax treatment across EU countries could broaden the base of capital investors and contribute to this endeavor. The final ingredient for a more productive Europe is a larger pool of qualified workers. This needs to be pursued in three ways: by making labor mobility more attractive, by activating underutilized workers, and by strengthening skills of workers. Let me start with labor mobility. The cost of relocating between EU member states is about 8 times higher than for relocation between US states. Measures to reduce these costs include recognition of academic and professional qualifications, better portability of pensions, and easier access to language training. Such initiatives can enhance cross-border mobility and facilitate talent movement from low productivity to high productivity firms, which are often concentrated geographically. What about expanding the labor force? European workers have shorter work weeks and retire earlier than in other regions. Enhancing incentives for prolonged work lives and addressing remaining obstacles to female labor force participation, particularly in child and elderly care, at the national level, can alleviate labor shortages. Furthermore, integrating cross-border workers effectively and enhancing public services in regions experiencing population growth are crucial. Simultaneously, reducing barriers to recruiting skilled workers from outside the EU can address skill gaps and enhance productivity. Moreover, Europe needs well-designed education policies that mitigate skill mismatches while jobs are being destroyed and created. Reskilling and upskilling should focus on enhancing digital skills, addressing knowledge deficits, and fostering preemptive acquisition of new skills through lifelong learning. Future workers will need to adapt, and they need to adapt well to a rapidly changing economic and technological environment in the age of artificial intelligence. Europe has made immense progress in integration, economically and politically, yielding substantial benefits. The journey needs to continue without any further delay. A fully integrated single market would greatly enhance productivity and, as a result, the EU's competitiveness. Undertaking the reforms to achieve a true single market would show once again how Europe can overcome even the most severe obstacles when acting decisively and together. Thank you.
Thank you very much. And now, as we continue to our panel, I will be moderated. I want to invite on the stage our panelists, of course, is Maria de Metzis, who's a senior fellow at Bruegel, and Christian Nickel, who is Deputy Director General at DG Economics at the European Central Bank. Thanks. Take your seat where you want. Here. Yes, you sit. Okay, excellent, very good. Well, thank you for the presentation. Many good slides, but the one that really caught my eye was the one about the venture capital deployed to the US and Europe. The picture basically just told you the entire story. It was absolutely flat for Europe. And On top of that, I think the report, we can all agree, is coming at a time in which there's a form of zeitgeist, certainly in Brussels, but not just, about how to create the next frontier in the European Union. And obviously everyone understands the challenges are now many, many for the Union, and something will have to change. But before we get into those specific details, or maybe it's not changes, but the implementation of those perhaps, I want to give you perhaps, to the two of you, just a quick floor to get some of your thoughts, reactions, and your take on perhaps some of the big picture views that Alfred also offered in his presentation. And Marie, if you want to go first.
Yeah, sure. If I may.
Yeah.
Wonderful. Thank you very much, Maria, and thank you to the IMF, of course, for the report, and to the ECB for inviting me. I have actually read the report religiously before, and have had the opportunity to discuss it in other occasions as well. So any opportunity to discuss the plethora of stories that you have in the report is very welcome, because it is exactly this. It is a plethora of very topical debates backed up with wonderful data. So I certainly recommend everybody to have a look at the report itself. Maybe I'll make 3 points, and there's just so many things to pick on, but the difficulty is to choose some. So maybe to pick on 3 that I think are extreme relevance here in Brussels, and of course not only in Brussels. Something on inflation, but I will leave Christian to comment on issues that have to do with monetary policy. But I would like to say just one thing. The ECB started the contractionary part of the cycle when headline inflation was at 10% and core inflation was at 5%. So around the September of 2022, these numbers were large. I could argue that the ECB was late in coming into the game. I would urge the ECB not to be late coming down. That's and here I think the suggestions that the IMF report makes, also on the speed of reducing it, is a scenario that one should envisage. But there is one thing that I think is still missing in the story, and that is there is no conversation on what we mean by inflation tolerance. Now, tolerance doesn't mean that we accept high inflation. Tolerance means that we need to live with some degree of inflation, and we need to understand what is acceptable and what is not acceptable, given that there is a trade-off with growth. We can reduce inflation, but can we reduce inflation at all costs? This is the bit that I think is, of course, the $1 million question, and the timing, of course, matters. The transmission of policy matters. But I looked at the data actually, just in preparing for this, just of the past 20 years, and inflation, let's say, in the first decade of the new millennium was at between 2 and 3. Then there was a period when it was below 2, very close to 1, and of course, the recent history where inflation was off the charts. If you accept the fact that we are living in an environment of extreme uncertainty, which I think is not very difficult to accept, we need to understand what we can put up with and what we cannot put up with. That's what I mean by tolerance. And in particular, because the trade-offs for reducing inflation are enormous and are very, very relevant. So I would have really liked to see some discussion of what is a level of inflation that indicates that policy should be a lot more active, and what is a level of inflation that policy should not do much. Giving me a number of 2% doesn't tell me much. Inflation was never at 2%. If you pick any time, if it would be on monthly data maybe, but yearly data, inflation was rarely at 2%, although your forecasts are always at 2%. And we know that forecasts in conditions of extreme uncertainty are not informative. We know that. Models are mean reverting. So we need to do something else there. And I think finding a communication strategy that tells us something about uncertainty is the way forward. And this is the bit that I think we need to talk about. The second thing is economic security. I think this is going to be the number one discussion, I think, in Brussels. And in terms of priorities, I think we'll come back to the priorities. I think this will be the number one priority, economic security. I give economic security 2 interpretations. One is looking for the process of de-risking, diversification, and I think Alfred talked about this in ways that I think make a lot of sense, primarily energy, but not only. Think of critical raw materials. How do we de-risk? How do we diversify? This needs to be part and parcel of all our policies. So that's one. And the other one is scale. And in a world of competing business models, if I may call it this way, how does Europe remain competitive, remain productive, and manage to operate? You have alternative models. China on one side that is doing a very particular business model, the managed state capitalism that leads to very strong industrial policy, and then you have the US that has got a very different business model, manages synergies in a very effective way, but also lately is resorting to some of this what we call industrial policy. What should Europe do? And I think we heard a lot of options on what Europe should do. The letter report, of course, was very indicative in this sense. What should we do to achieve scale? You know, I don't think, if I may be a bit provocative, if you allow me, it's not what we should do, is why haven't we done it? Yeah? Why haven't we achieved capital markets union? Why haven't we achieved banking union? We have banking union in supervisory terms, but we don't have a market for banks, a common market for banks. Banks remain very national in this respect. What makes us believe that we can have a capital markets union, even though I couldn't agree more how much we need it? There's a lot to be done here. And of course, what remains is pulling resources together, and I hope we can come back to that when we talk about priorities. And the other one is industrial policy. Should Europe also resort to industrial policy? And I think here the report has been very, very balanced in talking about not to fall into the temptation of going into industrial policy. And you've showed some very interesting numbers that are worth keeping on the back of our minds. On the other hand, you also have some very interesting words in which you try to guide the public in terms of doing industrial policy in ways that it is productive. So as you say, there is room for subsidies, and make sure that we use those subsidies in ways that we have the maximum of social welfare is really the way to do it. If I may make one more point, one thing missing from the report, and that is the issue of cohesion, because it's just as important. Growth is important, but in the EU we need cohesion. And you spend a lot of time, Alfred talked to us about productivity, which of course is important. The gap is huge with the US. Europe is not just 450 million people, it's also 27 countries. You just cannot depopulate countries for the sake of agglomeration effects. I think we need to be careful about this. And you know, the letter report talked about the right to stay. This is, I think, what he meant when he talked about the right to stay. Cohesion is just as important in the EU. It's not the same as the US. You can depopulate, or you can't find instances of areas in the US being depopulated. Not a similar strategy in the EU simply wouldn't work, because we have 27 separate countries that would simply not agree to the agglomeration effects. And part of the resistance that we see also on the CMU comes from that, very much from that motivation. Wrong though it may be in terms of achieving efficient economic outcomes, it does have social implications, and the EU is not just an economic institution, it's also a social institution.
Very much.
Thank
you for that, because I think you've nailed, perhaps if we were to add just the aspect of, and I know we're going to get into this, but the financing and the funding for this, and then it will take us into what is the joint or maybe not response, but I think you touched on every tension point that's out there for the debate. So thank you for that. Appreciate it. And of course, Christian, there's a question perhaps that you may want to comment on. There was maybe a soft criticism that the European Central Bank may have been late into the inflation cycle. Of course, I'm sure that you would say maybe if it was the case, if we look at numbers now, it has redeemed itself. But then looking forward, which is really the question, inflation has been a huge topic, not just in Frankfurt, but really here in every capital. And you've seen not just the economics, but also the politics of it that comes with a cycle like this. The expectation is in June, the European Central Bank will now cut rates. Of course, that depends until, well, the central bank announces it, and I'm sure you're not going to tell us what it's going to do in that meeting. But I wonder if it does happen, should you say the cycle of very fast inflation, very aggressive monetary policy is finished? How do you evaluate that? And then what comes after, essentially? It's now the big question. Beyond whether or not it was late, it's, I guess, as Maria noted, perhaps not being now late on the next phase.
Yeah, thank you, Maria, for this very interesting question. And also thank you, Alfred, for your remarks on the regional economic outlook, which I really think I have to agree with Maria is a very interesting report. And I very much recommend you all to read it. And I just before I get into this question of inflation and so on, I just wanted to say a few words on let's say, our take as the ECB on this kind of more long-term challenges. And we have a lot of cyclical challenges when you talk about inflation, etc., but there are also these long-term challenges. And it is really clear that Europe is losing export market share basically for the last 25 years. And this kind of loss in competitiveness has only been worsened by, on the one hand, the pandemic and the supply bottlenecks that we faced afterwards. We had the war in Ukraine, and we have the energy shock. And this, of course, impacted us as an open economy and an energy-dependent economy much more than, for example, the US. And to regain competitiveness, reviving productivity growth in Europe is key. And this is also where we at the ECB have done quite some work on this topic. And reviving productivity, of course, gets even more important now that we are entering in a phase where we have population aging and the related challenges for economic growth and sustainability, fiscal sustainability for Europe. Yesterday we had the Eurogroup meeting, and somebody said, yeah, well, how can you expect an aging economy to innovate? I mean, maybe the old people are not the one that are most innovative, huh? But the picture is not that simple, but just to keep in mind that this aging population, these effects, and there's been a lot of work on that, is now really kicking in, and we have to keep that in mind. And when you look at, and there's, I think, where the work that we do in the ECB and the policy take that we have is very similar to what you do. We would identify actually 3 important gaps that need to be addressed in Europe in order to actually regain this productivity and to also catch up again with the best performing economies. I mean, you mentioned already investment. I think the first thing is really to kind of try to cover up the investment gap that we have. I mean, Europe lags behind private and public investment. And when you compare private investment in the US, I mean, basically private investment has grown almost 3 times faster in the US since 2011 compared to Europe. And public investment has grown twice as fast in the US in comparison to the EU. And it's only thanks to NGEU that EU public investment has grown more in the EU than in the US lately. The second gap to address is the knowledge gap. Europe is behind R&D expenditure, digital innovation, digital uptake. In part, it has also to do with the lack of venture capital that we have. And this is also something that we have to bear in mind. And there are numbers out there that the most productive firms in the US spend so much more on R&D in comparison to European firms. And the third thing to address is the structural gap. And you already mentioned scaling, size. If you look at, for example, the size of the average companies in Europe, they are much smaller. So this question of scaling up, scalability of technologies, etc., is more a question for us than, for example, where you have different structure of the economy. At the same time, businesses in Europe face a lot of regulation. They have constrained access to finance, and labor shortages or skill mismatches are there. Aging population I already mentioned already, and this all leads to declining business dynamism and firms losing actually their edge, especially in manufacturing. And there we have to really rethink, let's say, the whole structure of how our economies actually work. Now, when you look at what is the ECB recommending, or what are our views on these 3 gaps, we basically have been putting forward really enhancing the capital markets union. I mean, this, I think, is an important step to actually have more access to funding. And it's really strange that we have been enjoying a single market for goods and people for over 30 years. But on capital markets, we are still more or less going solo. And that is simply something that just doesn't match. And so a single market for capital is essential for mobilizing private investments. And this is needed in particular for the green transition and the digital decision that is lying ahead of us, which will cost us millions. And it is also important then to finance the adoption of new technologies like artificial intelligence. The second important measure is removing any remaining barriers to the single market. I mean, we pride ourselves for the single market, fine, but there are still gaps in the single market. For example, in the services market, again, we are pretty much segregated. And this reaping basically, or removing this remaining barriers, can make production and supply chain much more resilient and boost economic and productivity growth. And finally, and you've also mentioned it, is indeed investing in people. Europe's most important asset is its people, and investing in education, research, and skill development can trigger innovation mitigate labor shortages and skill mismatches, and contribute significantly to closing this structural gap. Now, let me conclude. I mean, we at the moment are enjoying actually a rather robust labor market. And despite all the upheavals we had with the pandemic and so on, this had been sort of, this resilience of the labor market has been quite a surprise for many of us. And to maintain this robust labor market will be key, not only for the short-term economic outlook, but also for the future. And the qualifications and skills of the European labor force are decisive for long-term productivity growth and competitiveness. And here I would like to cite one of the speeches of Christine Lagarde, who said, it is by generating new ideas and creating the conditions in which they can spread and flourish through our economy that we can drive future growth.
Well, thank you for that and your overview. There is a question, and perhaps it's a question for both of you, and I think it's good that you set the scene before we get into the specifics, perhaps, of the central bank and the monetary policy, but obviously this has ramifications on everything that you do, clearly. There's a question, and again, going back to, there's a short term and there's a long term. And in the short term, there's now the question about, obviously, inflation and then what's going to happen to interest rates and so on. If you assume now that you enter into a cycle where the European Central Bank decides to cut rates and does so before even the Federal Reserve decides to do that, is that something that should be understood as potentially a risk, or is this just a natural course of closing a chapter? Is it appropriate, and what are perhaps the ramifications for Europe of this mismatch before of who goes first, who goes after? Because all of that in this global scenario obviously will matter in that extent. So a question maybe for Alfred, and then we'll go back to you, Christian.
Maybe first to say that when you look at the major central banks, the Fed, the ECB, the Bank of Japan, monetary policy decisions are a domestic matter. They are serving their domestic objectives and their domestic markets. And they're also large, so they dominate that signal. When we're looking at the issue of rate cuts, our assessment is that the right policy choice for the ECB is to start lowering rates. Inflation is coming down. We are confident that the ECB is going to reach the inflation target in the first half of 2025. So you don't want to be overly restrictive because in the end that has costs to growth. So that's the first point. The second point, of course, not even a large central bank lives in isolation. So what the Fed is doing or not doing has implications. When we are looking at that picture, though, the implications of a delayed rate cut by the Fed are probably relatively small for the euro area. We estimate that if the Fed rate is 50 basis points higher over a 12-month period than what we have in our baseline, and it's demand-driven, and that's what is going on right now in the US, the price spillovers are probably up to 0.2 percentage points, and also a positive impact on in the same size on economic activity. So that's a small number, but it's not nothing. And when we are looking at the ECB deciding about its rate cutting cycle, they will take that into account. They will take that into account like many other things which are still developing. We still are looking at services inflation and wondering, is it going to persist or is it coming down? We are looking at the conflict in the Middle East. Could it have spillovers on the oil market with price implications for Europe? We're looking at the Ukraine war, which again might have price implications. The ECB will need to take meeting by meeting the totality of data into account to make these decisions. But right now we would expect that the baseline forecast we have on quarterly rate cuts until September, starting in June, is the appropriate policy under these circumstances.
And just to put an end to this part of the debates because we have to look at essentially at what comes next, which arguably a lot more people say it's more relevant than getting stuck on who cuts first. But would you say this sort of concern about the European Central Bank front-running the Fed, that was not the initial timeline that many market players had in their head, is this exaggerated? Is there an element of hyperbole now in this? It will be fine ultimately.
Yeah. Everything regarding central banks right now is exciting, and it moves market. And I'm looking forward to the period where central banking becomes boring again. We are not in that situation. So I think it's a bit overhyped given the potential spillovers and especially given the risk to the inflation outlook. It's one of many shocks which may impact the rate cutting cycle.
And the reason why I asked specifically on this and insisted is because in June, obviously, this meeting will happen, but also even arguably in the medium long term, more importantly, is the European elections. And then obviously the jobs that will get assigned to who, it's a big question, but in terms of the makeup of the commission and those key portfolios, and that takes us essentially to what is the core of this debate, which is the medium even long-term priorities for Europe. I think what we've detected from some of your remarks that you've made today, but also the zeitgeist that we talked about, the letter report, also Emmanuel Macron when he spoke the past 2 weeks in Paris, the report that Mario Draghi is going to come out, is almost this anxiety of a Europe that is no longer as competitive, as productive, and by definition perhaps not as relevant in this global stage. So I wonder, is that something that you share? Is that anxiety valid? Is it underlying something? But also, if you assume we get to September, this commission is now in place, what would you say, top of the table, these are the two, three things that you should definitely now focus? There's no room now to delay further. Perhaps starting with you, Mary.
Yeah, so I mean, I think the numbers are what they are. We saw them in the report. The productivity numbers are we're lagging behind in the US than the US. And the question is, why do we care? I mean, we care. We are a continent that exports, so we need to remain competitive in the markets. And with that, I wanted to make one kind of distinction because it often gets mixed. The word competitiveness and productivity are often used interchangeably, and they're not really the same thing. And competitiveness is a zero-sum game. Somebody has to lose it for us to gain it, and the other way around. Whereas productivity can be a win-win, right? And I think the emphasis should be on productivity because that's where the gaps sit. With one maybe minor issue, which it's not quite so minor actually, and that is that in the global scene, those that are much more competitive kind of set the rules, and this is the issue here. In a multilateral system, which model are we going to follow? Will we be able to follow these open markets and where we are allowed to allow the industries to thrive, or are we going to follow the competitive market, which is what China is doing, where the state plays a very big role in there? And the question is, who influences the multilateralism in this respect? This is actually the big thing in Europe, and I think in the US, is that we might be losing out on our ability to set the rule system. China will be wanting to hold the pen when the new rule book is being written, in WTO terms or in any other term. And this matters, and this is why scale matters, and being able to have the opportunity to influence how we do business globally matters for competitiveness. So that's one thing. But in terms of what we need to do next, I think Christian talked about the investment gaps. I think this is priority number one in my view. We need to close some of these investment gaps because we have the money. It's not that I think Europe is still a rich continent. Mm-hmm. The European Commission forecasts 2.5% current account surplus in 2025. 450 billion of money will leave the European Union and go elsewhere in forms of investment. Private firms in Europe prefer to invest elsewhere. Can we bring this money back? Can we find ways of making exciting investors to actually stay here? And what can we do to help in this respect, right? CMU was mentioned many times. CMU is not a fast-moving agenda. Mm-hmm. It's not for the next 4 years. I hope we make some progress, but it's not going to make or break the European Union in the next 4 years. We need other stuff. And what other stuff are there? The taxpayer who always pays. It has to come from the taxpayer. Maybe the EIB. The EIB can play a big role in terms of levering up and attracting some private money where private money wouldn't go elsewhere. Mm-hmm. these are the options that we have, because I think the investment gaps is the number of the three that Christian talked about. I would not that I don't believe knowledge gap is important, obviously, absolutely, but the investment gaps are absolutely essential. I will start with that.
And I think that's also reflects a lot of the language that we heard yesterday from finance ministers for sure, but even von der Leyen herself, kind of this idea that how do you keep the money here, basically. It goes back to those three words, like keep it in Europe. Again, the question for you, Christian, of course, new commission sets in, election takes place. If you assume there's now this new momentum and everyone does what they say they want to do, and of course, we're still waiting for this Draghi report. There was some debate that it should have come before the election in some ways, but was still pending on that. What would you say now really cannot wait and needs to happen, but also at the ECB, what are the data points, I'm curious, that you will look at to say this is being well tackled now?
I mean, I think from a policy perspective, it's indeed for us, let's say the Capital Markets Union is one of the things that we would like to see, because...
But do you agree, like Maria said, that there's a lot of talk about it now, but this is not the big problem solver?
Yeah, but the thing is, I mean, it's related to the investment gap that we have. I mean, if you look at the numbers that are out there, the billions that are needed in order to actually get the green transition going or the digital investment going, then it's clear that with this kind of segregated capital markets, we will have difficulties to get there. And at the same time, I also would say that indeed anything that could foster investment, both private and public, and there we get into things like on private investment, that it has to become easier, you know, in terms of red tape, etc., to invest in Europe. I think that is also important. And if you are an outside investor and you're facing a market that is basically many separate countries, I mean, that will kind of put you off going into these investments. So making Europe, let's say, a more attractive place for investment means that we indeed have to kind of get away with regulations country by country and working indeed on this structural gap that we have.
Thank you for that. And Alfred, of course, a quick word to you, but also in your report you focus on productivity. Maria is very right. Competitive and productivity are not the same things. But I do wonder if we could get a word on both subjects from you, because I know productivity you dedicated a big amount of time to, and then you talk to these institutions. So I wonder what kind of feedback do you get on these dossiers that were mentioned?
First, very much with Maria, productivity is a win-win situation. Nobody minds a more productive Europe, because that will also mean more external demand for the rest of the global economy. This is not a zero-sum game. And productivity is something Europe can fix. You don't need any outsiders for that. But we also say the wrong way to go is protectionist policies, tit for tat subsidy wars. It's a loss for everybody, but it's in particular a loss for Europe, because Europe benefits from an open economy, and resilience of Europe relies in its external, in its internal market, but also in a diversified supply chain through its open trade system. So it's not competitiveness, it's productivity which is key. And it's not trade wars, it's fixing the own problems here.
But so when you hear, just to pick up on that point, particularly the head of the Commission, but not just, and we know that among the different member states in the EU, opinions vary, but when you hear terms like, or such as countries openly, like China, they're flooding the market, they're dumping on Europe, a probe will have to be opened. There's a number of sectors that the Chinese view strategically, and also for the sovereignty of the country, maybe Europe should do the same. How is that compatible with everything that you just said? Because clearly there's also a different political tone on this at times.
Yeah. And you're right.
It's aggressive language.
You're absolutely right. On this one, what we advise all trading partners to work for a cooperative solution. Because nobody is going to gain, everybody is going to lose if we go into a world of protectionism. When I look at Europe, it was always a champion of the multilateral trade system, of the rules-based trade system. That means to engage and to work along those lines, and not to fall into the trap and said everybody is overwhelming us and now we are building Fortress Europe. Our answer is, If you want to actually increase per capita GDP, focus on productivity growth, because that's something you have under control. Second point, going to Christiane's issue, there is enough capital around. We have open capital markets. If you can deploy that capital, American capital is going to happily going into Europe, and it's going to invest in Europe. It's not that we don't have capital. The problem is we don't have these striking investment opportunities where people want to invest in. We don't have the companies which have an expectation of scale to use the productivity advantages of ICT, of artificial intelligence, etc. That is the issue Europe needs to address. That's why you're looking for more dynamic firms. When you're looking at the single market, we discussed yesterday over dinner. Yeah. We were wondering, because in the US you have Amazon.com. You have, in the US, one single market, you have one Amazon, and you click and you order. In Europe, we wanted to click on Amazon.eu. Well, it tells you it has lots of other websites, Amazon.fr, Amazon.be, Amazon.de. So not even a scale firm like Amazon has a single unified approach to Europe. That's why you need to fix the single market. And you need more firms which are operating to scale. And for that, you need to investment. For that, you need to have the venture capital. You need to have the firms, but they also need to have the space in order to expand. And that's why you need to focus on the high productivity firms. That means investment in R&D. That means encouragement of R&D. And there, if you want to, that's where subsidy, industrial policy might want to come in, where public investment may be useful, but not for the wrong reasons.
So this approach, perhaps sometimes you hear it politically, that Europe, by precisely trying to play by the rules, by precisely focusing on that, or those points, has now become, excuse the expression, but sort of the sucker in the room. So it has a negative connotation now, that perhaps while everyone else was much more forceful, perhaps the European Union focused too much on being dutiful and respecting a system that they believe is the right system, but now it put you out. Is that something that would say there's a level of populism there too?
You see, people have been saying the European needs more teeth.
Yeah.
I would say the European Union needs grit. Lots of the stuff which needs to be resolved is tough politically to do. We don't have a banking union because of vested interests. Yeah. We don't have a capital market union because this is politically not that difficult to do, not that easy either, but it requires a lot of technical preparations on the bankruptcy law, on accounting, on tax system, etc. That's where European policymakers need to bite themselves into to solve these kind of problems. And it takes guts to do this, because when you look at the policymakers, the political horizon is 4 years. And the political horizon is mostly domestic. And Europe is going to lose out if that is the only side 27 sovereign states have inside. And I agree with Maria. The strength of a region in the end lies in the economic power. And were Europe to wither away economically, it's not going to count in the global power game. It's not going to maintain a multilateral rules-based trade system. So that's why it matters that Europe fixes the economic issues.
And on that point, since you mentioned Maria, also I know that you have been working on, well, what it's called, or also you referred to as the European strategic investments. Yeah. I wonder first if you could explain what it means and how will that feature into the policy calendar that may come.
Yeah, no, I think because all of this, I agree with everything that's been said. It's just that it is for the long run. It's not for the immediate future. So what can the next Commission do? What can the next 4-year cycle deliver? This is the bit that we try to think a little bit about, and of course the instruments that we have in our hands. And the instruments that we have are the budget, the European budget, the MFF. Of course, we can create new money, just like we did with the RRF. This came out of nowhere in times of need. There are some very good things that we've learned from the RRF, and the big discussion certainly in the next cycle is going to be whether that should be made permanent, or that's not going to be an easy political discussion, that's for sure. At the same time, I think the European budget has been 1% of GDP. If you add the RRF, you're coming to, although it's not in the same horizon, right? It comes to 1.7% of GDP. Can we increase the budget a little bit more to do more things together? So the motivation is, how can we finance all these investments? So what can we do in the meantime while we are striking for all these structural changes? And the question was, well, what do we need to do together? As Europe, what can we do together? Because if we don't do it together, it will be underprovided. This is the definition of a public good. Yeah, a European public good is something that unless you do it at the European level, you won't do it well, or you will be under-providing it. Yeah? Simply because there are economies of scale. If you think about cross-border investments, you travel in Belgium, you see the investment on streets stops at the border, and after that this is exactly it. It's a public good, and therefore if you do it at a one level up, you do it better. So the question is, what can you do at the European level to do it better? And of course climate comes into mind immediately, because climate is a global public good, not just the European public good. And if you don't do it together, you will do it less well, or you will do it in a way whichever country thinks is appropriate, which means that it's not well coordinated. So that is one European public good. What makes it strategic, and that comes to your question, something being strategic, it has to be in line with long-term priorities. Yeah, that's the word. I mean, we've had a huge discussion at Bruegel on what we mean by strategic. And quite frankly, I don't think there's one definition, but the one working definition is, how do we reorder priorities? Because you can't also say that priorities remain the same. The past 4 years have taught us this in the crudest of ways. Priorities change from one day to the next. Now it's defense. Yes. It wasn't last year. It wasn't 2 years ago, right? But now it is. So you need.
That's in detriment to. There's a lot of debate around this is going to be defense pivot, moving away from climate. I mean, all these priorities, as you say, they're reshuffling, they're changing. But do you believe this idea of defense being strategic now, is that coming in detriment of other dossiers, of other files? Or is there a way, as you say, to combine them in a more general sense?
We don't choose the problems that hit us. Mm-hmm. So if the issue of war is in our doors, we have to be very serious about it, right? And yes, it will come to the detriment of other agendas, unless the pot increases. Mm-hmm. It's not very more difficult than that. What is the pot that we can use together, and how do we divide it? Either the pot increases, or we divide it differently. And that's, if we divide it differently, then it will come to the detriment of things like climate, which of course is a big shame. Yeah, because that is also an existential crisis. It's just that it is a tragedy of the horizons, which is very far from now, whereas defense is immediate. Yeah, I don't think we can ignore defense. So yes, I think we have to do it. And this is why the issue of increasing the pie should also be on the table. To the extent that we can find the political will to do it, we should absolutely do it. But then, that's a political question.
And would you, because that's also the elephant in the room, but it's a very fair point which she's describing. Ultimately, one of the key instruments will be the European budget. I was at a conference 2 weeks ago, even the budget commissioner said, if you're honest at how things are and the level of challenges and the amount of just geopolitical issues that are happening on top of our own issues, economic issues, it is clear it's not sufficient. So then there's a number of instruments that could be brought about, and then there's of course also a question about the joint borrowing. A number of countries have already put it on the table. Some commissioners have even put a number of joint bonds that should hit the market. Again, it's always a delicate question, but is this something that should credibly be debated already? Even as you enter into an election, is that something that at least hypothetically, intellectually, has to be part of the debate, or is it too soon now? And ultimately the reality is, wait after the election and see what happens. But is there an actual need for it? That's fundamentally the question.
Yeah, we have been advocating a climate and energy security fund. And it's for the reason Maria mentioned. You have a public good, and you just have the gains by doing this together. This is just much more efficient to do that. That applies to other issues as well. That doesn't say how you finance it. That can be through the EU budget and membership resources. That can be through own resources. That can be through borrowing. That's a different question. And in the end, it's a question of prioritization, because the needs will always there, and you will need to prioritize in the end what is the most important part. But is there room for more EU and EU spending on some of these issues? And the answer is yes.
And maybe now I'm pushing it here a little bit, but as the IMF, would you say you have a preference for, you talked about a number of tools, a number of ways that this could be done. You said, yes, there is a need maybe perhaps for more. That's also something that's debatable. Would you have a preference? Would you say, as it stands, certainly because you don't know what the plan is, you can't make a sort of informed comment?
Yeah.
Although you know what the side guide is.
The most important part is, I know the disagreements between borrowing and non-borrowing. The most important is you need an instrument to address the issue. The financing of it is the secondary part, and we should not focus on that secondary part first.
Excellent. Of course, since we're talking about the general perspective, but also a strong economic component, this is also where fiscal policy perhaps may come into play. I wonder how relevant you think it is. And again, at times it seems this is, well, already it's a special year because you have the old rules that will come to an end, the new ones that have to be applied. There's all this talk about EDPs that could open for countries that have gone past those levels of debt deficit. But at the same time, you're also telling them very actively they have to spend on a number of issues, especially certainly if you're a NATO member. You're being told now specifically you have to do it. So it seems at times there's a form of cognitive dissonance between the two forces that are pulling in different ways. How do you make it more, I guess, cohesive in a way that there's a narrative or that works on both sides?
Maybe I start off on this one. That fiscal was really powerful was shown in the pandemic and in the energy crisis, because countries which had buffers were able to protect their populations from a meltdown in the pandemic and the cost of living increases during the energy crisis. So fiscal power matters, and fiscal buffers matters. So when you are coming out of a crisis with an increased debt level, it means you need to reestablish those buffers. And you need to make sure that your debt is long-term sustainable. And to add on and make the ministers of finance job even more difficult, you need to create room for future spending pressures, for higher public defense spending, for climate change, for health spending, for higher interest payments. You need to create that room. We estimate that for advanced European economies, by 2015, these additional spending pressures are 5.5% of GDP. You need to find a room for that. We are suggesting right now that we should do more on fiscal consolidation than what has been planned by countries. Why? Because labor markets are strong. Second, we see that output gaps are almost closed. This is an ideal time to start the fiscal consolidation. We are also looking at what countries can do. Some countries which still have energy cost of living packages and spending money on that. That's completely unnecessary, wasteful spending that needs to be taken out. Those funds can be used better. So that's something where we are, and you take them out, and the growth impact is almost negligible because the multiplier is so small. So you're in an environment where you go into a recovery, as we are saying. Labor markets are strong. This is the time where you take these measures and not postpone them into another time where you may be hit by another shock or the economy is becoming weaker. And early fiscal adjustment is helping with the credibility of markets, because it shows the seriousness of a country to take these measures. And I think that applies mostly to high-debt European countries, where this is really important. When you're looking at the medium debt countries, they have room to spend. They have fiscal consolidation is either not necessary or not that urgent. So in the end, it's a country-specific issue where you need to tackle and when you need to tackle these problems. But tackle, you need them, and you need to.
Thoughts on this point?
I think there's where I would say we have congruence between what we have been saying all the time, this issue of rebuilding fiscal buffers. We're entering, quote unquote, good times now, and we have a strong labor market, so this is the time to do it. This is one thing. The other thing, and that is also important to keep in mind, that we have to give priorities, and policymakers have to basically make sort of hard choices. And we as the European Central Bank also said all along that these energy support measures should be unwound as quickly as possible, because we have now, much better energy prices than we had that 2 years ago, and this is let's say an open issue still, and it's often because of these tough political choices that have to be made within countries, that such decisions are not taken at the right point in time. And just something to say, I mean, when you look at the architecture of the euro area, indeed, I mean, we have also been saying we need to think about a central fiscal capacity. Something that is helping, actually not basically on the euro area level, with fiscal policies, to also stabilize economies when there are cyclical or any other crisis issues. And this is still lagging in Europe or the euro area.
And it's still, I suppose, the big event, which again also takes us back to this debate of if you have an instrument that already was well received by markets, it's AAA rated debt, why is it still perhaps always the elephant in the room, I guess, in terms of whether there's a continuation beyond the 2026, which is also a fair point. I do want to get questions from the audience. If anyone has a question, I would like perhaps to, and then we'll go back into, yes.
Thanks a lot. I'm Stefano Spinaci from the European Parliament. I go back to the start, so to the $1 million question. I think we should upgrade to at least 1 million euro, not dollar, because of the inflation. So, but my question is about inflation and who and how should be absorbed inflation? How salary should be adapted or not? How profits should be touched or not by inflation? I was just looking to a graph and how the wages has increased in a Eurozone and the US, and also how inflation increased. And you can see that in the US, the wages constantly in the last 5 years increase more than the inflation, while in the Eurozone, the situation is a bit different. If we go toward a scenario that the 2% is not anymore a totem, but we will have higher inflation in a constant way, I think we should rethink a bit this kind of distribution of burden of the inflation between salaries, wages, and some others. That's my reflection. Thanks. Because that has also an effect on what we say investing in people. Low salaries, they cannot invest in education of their children and so on.
And I guess also he's making a good point in the sense that sometimes if you step beyond the Brussels bubble, no detriment to the Brussels bubble, obviously, we're all deep in the bubble today, so it's a very respectful place and we love it, but I think sometimes if we go beyond it, there is an element clearly where you can look at macro data and say this crisis after crisis over the past 4 years were objectively well handled, but it's not necessarily reflected on public opinion, and you need that public opinion to make those choices that you referred to. You look at some of the polling going into the European elections, clearly a lot of things are not resonating at all, and then if you go back to the question of a Europe that is a global power, that is competitive, that is strong and powerful, a lot of Europeans would say that they just don't perceive that and have not perceived that for more than a decade now. So I guess to bring that into also that context, it is something that's on the public side, guys, certainly. Is this decline also in your individual well-being, essentially?
When we are talking about policymakers did a fantastic job during the pandemic and also during the Russian energy shock, we are looking at what could have happened. You remember in the pandemic, we were looking down the abyss because we didn't know what would happen with the virus. When we had the Russian gas shut off, there was the expectation that actually we might have cold winters where there wouldn't be any heating. Policy action in the end took care of that and left us with pain in the first one, pain in the second one, And that's what people are experiencing. They're not looking at the counterfactual. They had a long time of pain. Second point, maybe difficult to compare the US with the EU when it comes to the energy price shock. That really hit the European Union. That was in terms of trade shock. That reduced incomes in Europe. Different in the US, which actually had a positive terms of trade shock. They didn't have the energy price issue. So different. But important point now to remember, we saw nominal wage growth. We are seeing real wage growth this year. This is underlying our projection that we actually have a expansion of consumption this year and then next year of investment. So that real wage growth is coming. For the medium term, and I think that's what we have been pushing so hard, it's productivity. Because real wages will be driven by productivity gains. And Europe needs to do better. And to have a per capita GDP 1/3 lower than the US is not something which you need to sit there and say that's what it is. Productivity will make the difference. It's not. It doesn't mean you need to work more. You need to increase the work effort. It's the technology embedded in the capital stock you have. It's the workers you are deploying with skills. There Europe needs to do better and needs to do better for its people, and the real wages will be driven by that productivity growth.
Unless someone has a further remark, we'll just take another question from the audience, yes.
Thank you. Yes, Adrien Baznet for Crédit Agricole, the French banking group. I have a question on the implementation of Basel norms, because the EU has nearly finalized the implementation of the Basel norms. The US are now expected to deviate from the international standards with broad and material changes. Do you think a gap between the EU and the US on the application of the Basel norms, on the own funds norms, would negatively affect the investment gap?
So this is
yes. Yes, about Basel III that nearly finalized in the EU. Will the divergence between the US and the EU application of these norms negatively affect the investment gap as we see now?
Okay, so a gap in the application of Basel III, if I understand it correctly, between the two jurisdictions.
Yes.
Who wants to go for this one? It's a tricky. But also yesterday in Paris, the French president was talking about this. You know, there's a reality that U.S. banks get to do things in a way that European banks, of course, do not. That takes us back to the banking union. So in some ways, all of this is always related. So I wonder, perhaps if not specifically on this point, but just in a general sense, there is a divergence between the two of them when you look at U.S. and European banks and the entire ecosystem. So how to close that? Perhaps in a broader sense.
Maybe just to say something from, let's say, the ECB's perspective here. I mean, we are having now sort of 10 years now of a single supervisory mechanism. So for 10 years, we are sort of really converged there in terms of supervising the big banks in the euro area. And I just wanted to say that this was successful, and because also we brought in place a certain amount of regulation. One could argue, okay, you have this regulation, but maybe this is harming us in terms of competitiveness. You have sometimes banks complaining that they have too much red tape, etc., and that in other jurisdictions that is not the case. But one should also keep in mind that because of this kind of regulation, we also managed to weather certain banking crises that were around us relatively well. I mean, for example, the banking crisis we had with UBS and Credit Suisse that was then bought by UBS, that it did not spill over to us. It had also something to do with the regulations that we have. And so to say that okay, we need to go down on regulation, I mean, there is a big risk that if we do that we might actually harm, let's say, our economies because we might have more unstable banks, and that we just simply have to keep in mind.
Do you believe, since he now switched to that, and of course it's very technical and it's a very political discussion, but this completion of this banking union, I've heard many CEOs who say, I don't see this moving at all. I would concentrate on the capital markets union because you have to be realistic. Is it too much to handle two at the same time? Do you share this perhaps optimism in one, pessimism in the other one? And this idea of the big European champions, it's like industrial policy. When we hear what are the big European champions in terms of banking, is that something that the sector may need, the economy may benefit, and ultimately will have to happen when it comes to a better functioning economy too?
I find it remarkable that we cannot finish the banking union. Okay. It's quite remarkable, actually, because we agreed on banking union. We've done 3 steps, we created institutions, and yet we cannot finish that. And that's actually part of the pessimism why I think the CMU agenda is much more difficult to move, because it pertains to very structural things, law systems, insolvency procedures, even down to the consumer and the financial literacy that the consumer has. How you expect a capital market to evolve if we have people that are not financial literate, types of that. These are very structural things. You need years of investment, education to get the CMU. So to think that we can do the CMU before we can do the banking union is a remarkable story to me.
But you hear it though at the Eurogroup. The finance ministers will talk now about CMU. There's a lot of optimism, and no one talked yesterday about EDIS. No one talked about the bank at all.
EDIS was killed politically, and that's why nobody wants to touch it. But I mean, I don't know that I am objective, but finishing EDIS, finding money for EDIS, ought to be easier than creating a capital markets union. Also because there are countries that have got developed capital markets, there are countries that do not have developed capital markets. So to create a union of countries that have developed, if you're the Netherlands, you have a very developed capital market, and countries that do not have capital markets. We saw the resistance from small countries last week, precisely because the creation of, it's again back to the cohesion argument, right? It will have agglomeration effects that may be good for European EU average productivity, but it won't be very good for European cohesion. These arguments are not secondary order arguments in the European Union. That's what I'm trying to say. And therefore they present a sort of physical constraints, in my view, in terms of what we can achieve. But I find it remarkable that we cannot finish banking union, quite frankly. I mean, I think that ought to be an easy thing to do.
It's a must continue to be a priority. Europe is really bank-based, and until it becomes more capital market-based, it will take time. So banking union is essential if we are talking about supporting the single market, if we are talking about dynamism in firms, if we are talking about that investment needs can be met of productive firms. So it cannot be dropped from the agenda.
Well, on that note, if there's a final question, we have time. If not, our speakers have been very generous with their time, and I know you have to leave on time because you're also busy for the rest of the day. So I would like to use this, unless anyone has one final pressing question, to give you the time perhaps. We've touched on a lot of issues today, but I wonder perhaps starting with Maria, and then we can go all the way to Alfred and Christian. Your final thoughts, constructions, priorities. So we've talked about many of them, but I wonder if I could just ask you to do your executive summary to say, this is how I see things, and I hope this can be accomplished. We talk about a new cycle that starts very soon, another 4 years. This is what I see top of the agenda now.
Yeah, that's right. So look, like I said earlier on, defense is of course existential, right? And I'm not trying to diminish the importance of defense, but I think climate, we must not forget climate. This is for many generations. So what I would like to see is identify 1, 2, 3 European strategic investments on climate issues and find the means to finance them. I believe that debt, when it comes to climate issue, debt is a good way of financing it because it is an intergenerational thing. And debt is intergenerational. That's why I would justify using debt issuance for climate investments, because it doesn't affect us, it affects many generations to come. So in the next 4 years, I would like us to find some sort of, I think the European Climate Fund that the IMF is putting forward is a very good way of putting that. Then we need to finance it. I hope we find it in us to find the finance first.
Thank you for that, Sam.
Well, I have to say, on the many questions that we have, what I would like to see really more generally is indeed sort of with this new commission, some kind of new impetus on bringing Europe together. And whether this is first on capital markets and then on banking union, or the other way around, or single market, and I really do not care as long as we're kind of moving along. And this is something that I sometimes see sort of lagging, is that there's still too much of a let's say, the look at your own country and that everything works right in your own country, that domestically everything is fine, and to lose the big picture that we are in this together as the European Union, as the euro area, and that we have to devise policies also together. So also on defense, for example, don't do it on your own. Try to work together there. Climate fund is another example, and leverage that when we are together, we're simply stronger. And then, as long as we kind of keep on moving in this direction, I think this is what I would like to see going forward.
Thank you for that. And Alfred, you're...
Just to underline what Christiane said, haste. Europe needs to move. It moved back from the global frontier over the last 20 years. And yes, we have 27 sovereign countries and nothing is going to be easy. But if these 27 sovereign countries want to increase welfare and want to project economic power in the world, they need to move together and they need to leave behind petty political issues, which may matter domestically, but hurt overall, including their own countries.
Well, thank you so much. We have reached the end of the session. Of course, Maria de Merces, Christian Nickel, and of course, Alfred Kammer of the IMF. Also to the House of the Euro for hosting us this year. Hope to see you again with the next edition of the report. Thank you for all your questions, and it was a pleasure to do this, and hopefully see you very soon. Thank you so much.